All right, January 2026. Gold just did something it had never done in all of recorded human history. It crossed $5,500 an ounce for the first time ever. Meanwhile, Bitcoin was bleeding out, down 47% from its October 2025 peak of $126,000, sliding towards $67,000, and the companies that had stuffed their balance sheets full of it were scrambling to dump it before it got worse. Two assets, both sold to you as hard money, both marketed as the escape hatch from a financial system held together with duct tape and wishful thinking. And at the exact moment the world was on fire and screaming for a lifeboat, one floated. The other sank like a grand piano thrown off a bridge. The standard take on this? Simple. Gold is old, Bitcoin is new. New replaces old. Progress, baby. That story is wrong. Not a little wrong, not well, it depends wrong. Structurally, foundationally, embarrassingly wrong. And the reason has nothing to do with algorithms or scarcity math or any of the things the YouTube thumbnails scream at you. It has to do with something that happened in a Byzantine trading port in 1043 AD, something almost nobody talks about, that reveals the only question that actually matters when you're deciding where to park your wealth. We'll get there. But first, we need to fix a definition that almost everyone, including most finance professionals, gets completely backwards. What does store of value actually mean? Because the answer most people give is wrong, and that wrong answer has quietly destroyed more wealth than any single market crash in history. Here's the popular definition. A store of value is something that holds its purchasing power over time. Gold does this. Bitcoin, they tell you, will do this eventually. Just be patient. Give it time. Sounds clean. Sounds reasonable. It's also not the right definition. A real store of value isn't just something that keeps its price, it's something that stays exchangeable under maximum pressure. And those two ideas are not the same thing. Not even close. Here's a quick reality check. 2022. Bitcoin dropped 65%. That same year, U.S. inflation hit 9.1%, the highest since 1981. If Bitcoin was ever going to prove itself as an inflation hedge, that was its moment. That was the Super Bowl. Instead, it lost more than the S&P 500, which only fell 19%. Bitcoin didn't just fail to protect people, it made things actively worse. It amplified the damage it was supposed to prevent. Gold, meanwhile, held essentially flat in dollar terms across the full year and was up around 18% measured from its March peak. While everything else was on fire, gold just sat there, doing its job. Boring, reliable, infuriating to the crypto crowd. But 1 year isn't a thesis. 1 year is noise. So let's actually zoom out. Not one market cycle, not 5 years, we're talking decades, centuries. Because the case for Bitcoin as a store of value rests entirely on extrapolation, 14 years of price history projected forward into forever. The case for gold rests on observation, thousands of years of data, stress-tested through plagues, famines, wars, and the complete collapse of entire civilizations. And here's the thing the crypto analysis crowd consistently gets backwards. They compare Bitcoin's returns to gold's returns. That's the wrong comparison. Returns measure how an asset performs when things are going well. Store of value status is measured by how an asset performs when things are falling apart. Testing a parachute by jumping off a dining room chair is not the same as testing it from 30,000 feet, and the stakes are slightly different. Now, here's where the data gets genuinely uncomfortable for the Bitcoin camp. Between 2020 and early 2026, something structural shifted in how Bitcoin moves. CME Group data shows Bitcoin's rolling correlation with the S&P 500 went from essentially 0 before 2020 to around 0.5, and by March 2026, the 30-day correlation hit 0.74. On certain intraday windows, the R-squared touched 0.94. Read that again? 0.94. That means, for brief but critical stretches, Bitcoin moved almost identically to the U.S. stock market. Not like gold, not like a safe haven, like a leveraged tech stock wearing a hoodie. Nasdaq analysis confirmed the pattern year by year. 2024, S&P up 24%, Bitcoin up 135%. 2023, S&P up 26%, Bitcoin up 147%. 2022, S&P down 19%, Bitcoin down 65%. Every single year, in both directions, Bitcoin took whatever the stock market did and turned it up to 11. That's not a store of value. That's a mirror with a magnifying glass welded to it. And calling it a safe haven at that point is optimistic. Generously optimistic. Now, Byzantium, 1043 AD. Stay with me, because this is where it actually clicks. The Byzantine gold solidus had been the backbone of Mediterranean trade for over 700 years. Merchants from Baghdad to Venice priced goods in solidi. It was, for its era, what the US dollar is today, the world's reserve currency. The thing everyone trusted, the thing that made trade work. Then, Emperor Constantine IX did what emperors always eventually do when they need money and don't want to admit they're broke. He debased it. Shaved the gold content down, mixed in cheaper metals. On the surface, identical. Same stamp, same name, same weight, same coins. Different coins. But the merchants in the ports of Trebizond and Antioch figured it out. Not through any official announcement, not through an audit. They weighed the coins, scratched them, pressed them against touchstones. Within months, the fraud was exposed, not in a palace or a parliament, but at the point of exchange, the moment someone actually tried to spend the thing. Here's what matters. A debased solidus sitting in a vault still looked like money, still felt like money, but the moment it needed to perform under pressure, the moment it met a skeptical merchant with a scale and a touchstone, its true nature was exposed instantly. Gold can be verified by anyone, anywhere, with technology that existed in ancient Lydia: a scale, a touchstone, acid. Done. A jeweler in 1043 Trebizond used the same basic techniques that a pawn shop in 2026 Detroit uses today. No power grid required, no internet, no third party, no password. Bitcoin requires an entire ecosystem just to confirm it exists. Nodes, miners, internet connectivity, electricity, private key infrastructure, exchange liquidity. Remove any single one of those and your Bitcoin doesn't disappear, but your ability to exchange it does. An exchange under stress is the only test that has ever mattered. Which brings us to the graveyard, because this has all happened before, many times. Carmen Reinhart and Kenneth Rogoff documented 800 years of financial crises across 66 countries, 250 sovereign defaults, 150 banking crises, dozens of currency collapses. The pattern they found is relentless. Every fiat currency eventually fails, no exceptions. Average lifespan? 35 years. The Roman denarius inflated away over centuries. The Chinese jiaozi, the world's first paper money, introduced in the 11th century Song dynasty, hyperinflated within 150 years of its creation. The French assignat, backed by seized church land during the Revolution, lost 97% of its value in 4 years. The German Papiermark, the Zimbabwean dollar, the Venezuelan bolivar. In every single one of these collapses, gold retained exchange value. Not theoretical value, not if you can find a buyer value, actual, in the moment, someone will trade food for this value. Bitcoin has survived exactly 0 currency collapses. 0. It was born in 2009 during one of the most extraordinary periods of monetary expansion in history, when central banks printed roughly $25 trillion in new money. Bitcoin didn't survive a crisis, it was born from one. And it has never been tested outside the environment that created it. The one partial test we got, 2022, it failed. Let's make this concrete. Venezuela. The bolivar lost 99.9% of its value between 2016 and 2021. Inflation hit 1,000,000% in 2018. The Venezuelan government launched its own cryptocurrency, the petro, backed by oil reserves. It was a scam, and everyone knew it within months. So what did ordinary Venezuelans actually use? Some did use Bitcoin, that's true, and Bitcoin advocates love citing it. But data from local Bitcoins, the peer-to-peer exchange that operated there, shows something those advocates rarely mention. Volume peaked in 2019 and then fell sharply. Why? Because as the crisis deepened, electricity became unreliable, internet access became inconsistent, the infrastructure that Bitcoin depends on started crumbling under the exact pressure that the crisis generated. The thing Bitcoin needed most is the thing a collapsing society destroys first. What didn't crumble? Physical US dollars and gold, specifically small gold nuggets traded in the mining regions of Bolivar State. Miners there built an informal economy where gold dust, measured in grams on small scales, became the functional currency. No blockchain, no seed phrase, just metal, weight, and 5,000 years of precedent. When civilization degrades, you don't get to choose which parts of the infrastructure survive. The universe doesn't take requests. The Bitcoin maximalist response to this is always the same. You're comparing a 15-year-old asset to a 5,000-year-old one. That's not a fair test. And they're right. It isn't fair. But the universe doesn't grade on fairness. It grades on survival. Always has. Now here's where the conversation gets genuinely uncomfortable for both sides. Because gold has a flaw, a serious one. And it's the exact flaw that gave Bitcoin its opening in the first place. Gold is heavy, expensive to store, brutally difficult to move across borders. Transporting $10 million in gold requires armored vehicles, insurance, days of logistics, and a serious conversation with customs. Moving $10 million in Bitcoin takes 10 minutes and a smartphone. For a young person in Lagos or Buenos Aires or Dakar trying to protect savings from a collapsing local currency, that portability isn't a minor convenience. It's potentially life-changing. And this is where gold advocates owe people some honesty, because custody has historically been weaponized. In 1933, Franklin Roosevelt signed Executive Order 6102, making it illegal for American citizens to hold more than 5 ounces of gold. The government set the confiscation price at $20.67 per ounce, then immediately revalued gold to $35. That's a 40% theft of purchasing power, executed by the government against its own citizens in broad daylight with a signature. The people who had stored gold in bank vaults, where the government knew exactly how much they had and exactly where it was, got robbed. The people who buried it in their backyards, they were fine. The lesson there is darkly funny if you think about it long enough. Bitcoin fixes this specific problem elegantly. A memorized seed phrase can't be confiscated at a border checkpoint. It doesn't trigger a metal detector. It doesn't appear on an X-ray. For someone fleeing a hostile government, that's not a theoretical edge. That's a survival edge. So both sides are right about the other side's flaw. The Bitcoin crowd correctly identifies gold's confiscation problem. The gold crowd correctly identifies Bitcoin's infrastructure problem. What neither side wants to acknowledge is their own floor, and both floors are real. That asymmetry matters more than any chart. March 2020, COVID hits. Bitcoin dropped 37% in a single day, March 12th, now called Black Thursday in crypto circles. Exchanges froze. Liquidation cascades wiped out leveraged positions. The very infrastructure that makes Bitcoin portable also makes it fragile. Gold that same week? Physical premiums on gold coins spiked to 10 to 12% above spot. People weren't selling, they were hoarding. The thing you can hold in your hand, the thing that requires no Wi-Fi password and no exchange login, behaved exactly the way a store of value should during panic. The crypto crowd points to Bitcoin's eventual recovery. And yes, by late 2025, it hit $126,000. But recovery speed is not crisis performance. A car that crashes at every intersection but gets repaired quickly is not a safe car. It's just an expensive car with a good mechanic. Lynn Alden in Broken Money reframes this entire debate in a way that cuts through the noise. The real distinction isn't gold versus Bitcoin, it's analog hardness versus digital hardness. Gold is analog hard money, scarce, durable, millennia tested, but slow and physically cumbersome. Bitcoin is digital hard money, fast, portable, programmable, but young, volatile, and dependent on infrastructure that didn't exist 20 years ago. The question isn't which one wins. The question is, which failure mode scares you more? And the answer to that question should determine how you allocate, not which camp has the louder Twitter following. Now, if you want to know what the most sophisticated financial institutions on Earth actually believe about this question, not what they say in press releases, but what they actually believe, don't listen to their words. Watch their purchases. In 2022 and 2023, central banks bought more gold than in any two-year stretch since 1967. China's central bank added over 300 tons. Poland bought 130 tons. Singapore, India, the Czech Republic, all net buyers. The World Gold Council projected central bank demand averaging 585 tons per quarter through 2026. Not a single central bank on Earth holds Bitcoin in any meaningful reserve. Not one. The U.S. Strategic Bitcoin Reserve announcement in early 2025 made enormous headlines. Read the fine print. The reserve was primarily Bitcoin already seized from criminal forfeitures, not new purchases. And its total value, even at peak prices, represented a fraction of a percent of U.S. reserve assets. Compare that to Fort Knox, holding over 4,580 tons of gold, valued at roughly $21 trillion at current prices. Central bankers are conservative, bureaucratic, and slow. But they're not stupid. They've watched every monetary experiment in history play out. They've read Reinhard and Rogoff. They know what survives. When the People's Bank of China buys 300 tons of gold, that's not a fashion statement. That's preparation for a world where dollar dominance weakens. When Poland, a NATO member, a Western-aligned democracy, becomes one of Europe's most aggressive gold buyers, it's not because gold is trending. It's because Poland shares a border with a war. And here's the detail that gets buried under the headline numbers. Central banks don't just buy gold, they repatriate it. Germany spent years retrieving its gold from vaults in New York and Paris. The Netherlands did the same. Hungary, Poland, Romania, all moving physical gold from foreign storage back to domestic vaults. Why? Because having your monetary insurance stored in someone else's country is like keeping your fire extinguisher in your neighbor's garage. Convenient for them, useless for you when it matters. That behavior tells you everything. When the institutions with the most resources, the most data, and the most at stake make their actual choice, they choose the thing they can physically touch. What they're telling you with their balance sheets, not their press conferences, is that gold is the only asset they fully trust when everything else is burning. The reason keeps coming back to verification. Gold can be confirmed by anyone, anywhere with Bronze Age technology. Bitcoin verification requires a globally distributed network of computers running around the clock, consuming electricity equivalent to a mid-sized country, maintained by miners whose economic incentives must stay aligned with network security. If hash rate drops, because energy prices spike, because regulation bites, because a more profitable opportunity pulls miners elsewhere, verification slows, eventually stalls. Saifedean Ammous made the hardness argument for Bitcoin in the Bitcoin Standard. After the 2024 halving, only 3.125 new Bitcoin are mined per block. The supply schedule is fixed, transparent, immutable. Mathematically, he's right. Bitcoin's stock-to-flow ratio makes it extraordinarily scarce. But hardness is necessary, it's not sufficient. Rhodium is scarcer than gold. Osmium is denser. Neither is money. Because money requires something beyond just being hard to produce. Economists call it salability across time and space. the ability to hold value and be exchanged reliably everywhere, in every condition. Gold passes this test in a war zone, in a blackout, after an earthquake, on a boat, in a jungle. Bitcoin passes this test in a Starbucks with reliable Wi-Fi. That asymmetry matters more than any stock-to-flow model or supply schedule, because the moments when you most desperately need a store of value are precisely the moments when sophisticated infrastructure is least available. Now, here's the part that neither camp wants to sit with. Gold's 5,000-year track record contains long stretches of genuinely terrible performance. From 1980 to 2000, gold fell from $850 to $252 per ounce, 20 years of decline. Someone who bought at the 1980 peak didn't break even until 2008. That's 28 years of dead money. Bitcoin, for all its volatility, has produced generational wealth at a speed history has no precedent for. Someone who put $1,000 into Bitcoin in 2013 held over $5 million by 2025, even after the crash. So the honest answer, the one that nobody in either camp wants to give because it doesn't fit on a bumper sticker, is that they solve different problems. The investors who got wiped out in 2022 weren't people who held Bitcoin. They were people who held only Bitcoin and told themselves it was a hedge. They confused upside potential with downside protection. Those are opposite things. An option on a startup has upside potential. A treasury bill has downside protection. Nobody would mix those up. But the crypto narrative successfully convinced millions of people that Bitcoin was both a moonshot and a safety net simultaneously. 2022 demonstrated, with some enthusiasm, that it was neither at the same time. Meanwhile, the investors who missed the greatest wealth creation event in financial history weren't people who held gold, they were people who held only gold between 2011 and 2020. While gold went essentially sideways, Bitcoin went from $1 to $29,000. A $10,000 Bitcoin allocation in 2011 was worth over $290 million by 2021. A $10,000 gold allocation over the same period was worth maybe $12,000. Both groups made the identical mistake. They treated a spectrum like a light switch, on or off, gold or Bitcoin. Pick a tribe. Gold answers one question: what do I hold when civilization becomes uncertain? Bitcoin answers a different question: what do I hold when I believe civilization is about to accelerate? These are fundamentally different bets. One is a bet on entropy, that systems crack, governments fail, complexity collapses. The other is a bet on growth, that technology compounds, adoption spreads, networks deepen. And right now, in April 2026, with gold near $4,700 after touching $5,589 in January, with Bitcoin at $71,000 after falling from $126,000, with a U.S.-Iran conflict disrupting energy markets, with companies liquidating Bitcoin treasuries to cover convertible note obligations, the market is pricing in more entropy than acceleration. That doesn't mean Bitcoin is finished. It means Bitcoin is currently telling you something about the state of the world that its loudest advocates would rather not hear. Here's another data point that rarely makes it into the debate. Bitfarms, one of the largest Bitcoin mining operations in North America, announced in early 2026 that it was no longer positioning itself as a Bitcoin company. It rebranded as a firm building AI data centers instead. When mining costs hit $80,000 per Bitcoin and the price dropped below that floor, the economic model that secures the entire network started showing cracks. Gold mining has no equivalent fragility. If gold prices drop below extraction costs, mines shut down. But the gold already above ground doesn't become harder to verify. It doesn't become less gold. The existing stock persists completely independent of whether anyone is mining more. With Bitcoin, the mining process, the hash rate, the network security is the foundation that gives the existing supply its reliability. Take away the foundation, and the structure above it wobbles. And this is the pattern that repeats throughout history with a consistency that starts to feel less like coincidence and more like law. The families who fled Saigon in 1975 sewed gold into their clothing. Jewish families escaping Nazi Germany converted what they could into gold coins and diamonds. Kuwaiti families fleeing Saddam's 1990 invasion carried gold. Not stocks, not bonds, not property deeds. Those documents became worthless the moment the border shifted and the government that backed them ceased to function. Gold needed no government to back it. It just needed to exist. This pattern repeats so consistently across so many different cultures, centuries, and catastrophes that it stops being anecdotal. When the social contract breaks, when the institution that issued the currency and maintained the ledger and guaranteed the deposit disappears, the only thing that holds value is the thing that never needed a guarantee in the first place. Gold has never needed a government. Bitcoin has never existed without one. So when someone asks you gold or Bitcoin, understand that the question itself is the trap. It forces a binary on a problem that demands a spectrum. The real question is, how much chaos are you actually pricing in? If your answer is some, if you believe governments are reckless but functional, that the system is stressed but not shattering, then Bitcoin's asymmetric upside might justify its asymmetric risk. If your answer is a lot, if you believe the debt spiral Reinhardt and Rogoff documented across 66 countries is approaching its terminal phase, then you need the asset that has survived every single breaking point in recorded history. 5,000 years of data isn't a guarantee, but it's the closest thing to one that money has ever managed to produce. That Byzantine merchant in 1043 scratching a coin against a touchstone in the port of Trebizond, he understood something that all the algorithms and white papers and influencer threads in the world haven't improved on. The test isn't what your money is worth in calm water. The test is what it's worth when the storm hits, the power goes out, and the only thing standing between you and nothing is whatever you're holding in your hand. And money never learns. We keep saying it, and history keeps proving it. The next trap is always already being built before the last one closes. Most people won't see it coming until their portfolio is already underwater. If you'd rather see it before it matters, the subscribe button is right there.